Fixed asset allocation. This is another kind of asset allocation strategy. In fixed asset allocation, we invest in fixed proportion in different asset class. For instance, let us take 50-50 in equity and debt. This is an example. So if I have to invest 100, I will invest 50 in equity, I will invest 50 in debt. So this is the starting position. And after a year, I will rebalance the portfolio. In fixed asset allocation, rebalancing is done periodically so that we again come back to the normal starting asset allocation pattern, that is 50-50. Say, let us see with an example. Let us follow 50-50 rule. This is just for an example. It could be even 60-40, 30-70, 40-60, any kind. Let us see with an example. Let us assume 50% in equity and 50% in debt. After a year, equity markets double. So do my investments also. So my equity portion, that is 50 in equity, becomes 100. Becomes 100 after a year. Debt market, I had invested 50. Let us assume it fetches 8%. So after a year, 50 in debt market fetches 8%. It means it becomes 50 plus 4, 54. So the total value becomes, after a year, the total value becomes, I had invested 100, 50 in equity, 50 in debt, but after a year, it becomes total value 100 in equity, 54 in debt. So total value becomes 154. But is this the value we started with? No. We started with 50-50. Now is the percentage allocation same? No, because equity has more. Equity has 100 rupees, whereas debt has only 54 rupees, isn't it? So how to rebalance? How to bring back? So we started with 50-50 rule. So you add both, the total value is 154, that is my portfolio value, you divide by 2. So equity should have 77 rupees, debt should have 77 rupees. So I take 23 rupees from equity. Equity right now it is 100. I take 23 rupees from equity and I will add 23 rupees to debt. So equity becomes 77, debt becomes 77. So this idea is known as fixed asset allocation strategy. So the advantage of this strategy is that whenever market increases, I mean the stock market increases, we are rebalancing, we are taking the money out and we are investing in the other stable parts to make to maintain the same proportion. This is the advantage in fixed asset allocation strategy. The next asset allocation strategy would be flexible asset allocation strategy. So what is flexible asset allocation strategy? See here, flexible asset allocation strategy is a strategy where all asset classes are involved and there is no fixed proportion as such. The proportion depends on the fund manager. We have seen earlier about asset allocation funds. So the same logic is applied here. The fund manager takes a call based on the market condition. So there is no fixed rule here. It can be anyway. It can be anything like more into equity, less into debt, or more into debt, less into equity, or more into gold. It can be anything based on the fund manager. This type of asset allocation is known as flexible asset allocation. This is quite risky when compared to the previous two, fixed asset allocation and strategic asset allocation. We have one more asset allocation type known as tactical asset allocation. See here, tactical asset allocation is about investing based on likely behavior of markets. Based on likely behavior of markets. If I feel that, for example, if I feel that equity markets will increase, if I feel that there is going to be a bull run in equity markets, I will dump my entire amount in equity. I will invest my entire amount in equity. with the hope that it will generate higher returns, with the hope that soon the bull run will start. This asset allocation never follows any method. It rudely follows which asset class will perform better, and we will dump the funds in that particular asset class. So there is no diversification as such, and it is very, very risky to invest or to go by tactical asset allocation. So only investors with huge surplus are capable of doing tactical asset allocation. So these are the various asset allocation strategies we have.